Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, Ryan here. I am a mortgage nerd. Welcome to the Clear to Close podcast. I'm with Patriot Home Mortgage. And today I want to debunk some common myths about getting real estate or buying a home. Just some mortgage myths that I've seen out there that I think are kind of interesting. They just kind of replay on the questions that I see. I see all these Q&As that have some of these questions. So I thought it'd be fun to kind of debunk the three biggest myths when it comes to getting a mortgage. So let's go to slide number 1, and we are going to talk about the three. The three are down payment. There's a lot of mystery about how much you actually need to have saved for a down payment. A lot of times people will call me up and say, well, I've got some money for a down payment. And I say, okay, how much? And I've got $3,000 or $4,000 or $5,000. When a lot of times down payments are a percentage of the sales price. So I want to demystify a little bit what is required for down payment. Next is credit scores or credit history. I want to break that down. Some of the most common questions we get is getting bad loans or getting loans with bad credit. So I want to review that. And then last, renting is cheaper than buying. So let's break down those three different topics, and we'll have some fun here on these little debunking and demystifying these mortgage myths. Let's go to slide number 2. So the big myth that you hear a lot is I need 20% down to buy a home. There's many 100% financing programs, but I've had people say, well, if I don't have 20% down, I've got to pay a lot more for the home. The rate's higher. I have to add this mystical mortgage insurance and things like that. So that is true. There is some additional fees. Sometimes the rates actually can be a little bit lower when you have mortgage insurance because you have some additional protection for the lender that if you default, there's that extra insurance. But there is 100% financing programs that are available, but then the next tier is 3% down. So not just a generic number of $5,000 or $4,000 or $10,000. It's 3% is kind of the next tier if you're not doing 100% financing. Then the next one's 3.5%. I know it seems weird. It's like 3 to 3.5. What's the difference? Well, they're two different programs that have different requirements. After that, it's always 5% increments. So you go to 5%, 10%, 15%, and so on and so forth. So there's really not a benefit to put, say, 7% down or 8% down because you're still getting the rates and terms, the guidelines on as if you put less down to that specific tier. One other thing that we've seen is there's a lot more down payment assistance programs, a lot more 100% financing programs. And a lot of times when I sit down with clients that have, say, 10% down, but not 20%, a lot of times we say, why don't we go to 5%, use that difference to get rid of other debts? Maybe we can get rid of all the other car loans or get rid of other payments so then you can afford a little bit more while staying within your budget. And that really is very helpful when home prices have gone up, interest rates have gone up, is to look at all of the financing, all of the money you're paying every month, and be able to see if we can squeak out a little bit more without having to raise the income level so much. You know, if you can get rid of $400 or $500 worth of other credit card debt or student loan or car loans or something like that, then maybe you can afford a home that's a little more in the area you want to be or this bedroom count or location or something else like that without all of a sudden having your payment be $400 more every month. So that's part of my job is to sit down there and kind of review, okay, here's where we're at. Here's some other ways maybe we can squeeze a little more out of this without putting you in a situation where your debt ratio or really have to stretch so much more. It's just looking at all the things that you're paying on. Let's go to the next slide. This I thought was pretty interesting. 80% of first-time homebuyers qualify for 100% or some sort of down payment assistance program, yet only 13% use those programs. So there are a lot out there that people just aren't using. Either they don't know about it, or maybe there is a disadvantage with that loan. Maybe they have enough money down and they don't need to use the down payment assistance programs. But I feel that there's probably more that could have used them that just didn't know about them or didn't go through the research or something along those lines. So I find that having knowledge about how they work can really help on what you're doing with your down payment. And there can be a benefit, again, from putting 5% down instead of the 20% down, because that 15% might be better served somewhere else in savings, paying off other debts, emergency funds, retirement accounts. There might be other places to put that money that could be better served. I even had one guy that was going to put a bunch of money down, and we were able to show him he can buy a rental property and this property at the same time. So he has a cash flowing property and his primary residence for the same amount of money. He's still working with the same amount of money, but now his overall debts have gone down because of that rental property. I know some people don't want to be landlords. Some people don't want to be real estate investors. I totally get it. But just at least having somebody that can sit down with you and say, okay, I've got this much money to work with. Here's my debts. What can we make work out of this? What are some things I can do to either increase my buying power, lower my overall budget, increase my savings, emergency funds? There's lots you can do with that. Because once you put the money down, you really can't get it back without selling or refinancing the home. So up front, if you can have some strategies or at least know about them, maybe you'll change what you want to do. I see a lot of people do this as they upgrade. So they will sell a house and get a bunch of money from the sale of the house, and they think, oh, I'm just going to take the entire thing and put it on the new house. But then they'll still have all these credit cards or auto loans or no savings or no emergency fund. And I'm like, well, wait a minute, let's reevaluate that a little bit. Let's put this money down. Let's make the numbers work, but let's see where else that money might go that can diversify it. I mean, we diversify in stocks and bonds, commodities. I mean, that's a pretty normal thing for financial planning, yet people don't apply those similar ideas to when they sell a house or when they buy a house with that down payment. So I think that's something to kind of demystify the idea that you have to have 20% down. Really, there's 100% out there, but the average I saw of first-time home buyers is around 6%. That's usually the average. For upgrade buyers, it's around 18%. So still, even with some upgrades, they don't necessarily do 20% down. So it's kind of an old myth that's going away because of the advancement of mortgage insurance and some of these programs that have helped lessen the down payment load. Now, one other tip here on first-time home buyers. When you hear the word first time, it's like the first time you drove a car or the first time you did whatever. You think first time ever. If you haven't owned a home in the last 3 years or 36 months from a bankruptcy, foreclosure, or from owning a home, you're now reclassified as a first-time home buyer. So even if you've had 10 homes in your life, 100 homes in your lifetime, if you haven't owned one in the last 3 years, you now get access to some of these first-time home buyer programs. So it's not first time ever. It's kind of misleading a little bit. It's just within the last 3 years. So if you've been out of the market, haven't owned a home, relocated, went through a bankruptcy, divorce, whatever it might have been, that you were not been a homeowner for the last 3 years, you actually are now considered a first-time home buyer again. So now let's go to the next slide. So let's go to the next little myth here. Perfect credit. So a lot of people will think you need perfect credit to own a home. Now, credit scores are going to factor into your interest rates. Certain programs require higher credit scores, but you don't need perfect credit to own a home. Many of these first-time homebuyer programs can go all the way down to a 580 credit score and still get you qualified. But if we can get you to 620, which isn't crazy hard to do, then you're going to see a lot better programs, better rates, better terms, which really means better buying power. So if all of a sudden you're right on the edge of being able to qualify for a home, if your score was a little higher, then maybe that's a little cheaper for the same home, or now maybe you can afford a little more home because the interest rates, the term, the down payment requirements are less. So it's misleading that you need perfect credit to get the home, but obviously working on your credit can make a big difference. So really 620. It was amazing how many more things kick in at 620. Most credit is on 20-point tiers. So if you're 621 to 639, that's one tier. You're kind of getting the same within that range. And every 20-point tier above that, you're opening up the doors to better interest rates potentially, cheaper mortgage insurance, and that way your buying power can increase. Or loan to value will increase, so less down payment. Maybe your job history doesn't have to be as strict. You don't have to have compensating factors for the credit score. And also some of these programs will have a credit score minimum, but they also look at the history. So I've seen people that have surprisingly higher score, but have some sort of 30-day or 60-day late on their credit that can still exclude them. So it's a combination of credit score and history in most cases, especially over the last 12 months. But it is really something where we want to work on getting your score the way it is. So I found a couple fun little stats here. Let's go to the next slide real quick. So this one is, what do you think? And so I got Freddie Mac, my producer here. What do you think the average credit score is in the U.S.?
In the U.S.? Mm-hmm. Low 600, 610.
Nope.
5.
Higher.
7, really?
Higher. Yeah.
611.
Higher.
612.
More.
I don't have faith in people.
Get a 7.
612. 7?
Get a 7 in front of it.
An average is 700?
Yep.
No.
705. Now, it depends on if it's FICO, Vantix, Experian. I saw is 705 up to 717 is an average. So I actually saw higher. And I remember about 5 or 6 years ago, I looked at this and it was like 690. So we have increased. The credit scores have actually improved over the last few years, mainly maybe a knowledge of it or how it works, or people have been a little better at managing their credit. We haven't seen foreclosures and bankruptcies as much in the last few years because of some recovery efforts, or people already kind of had their bankruptcies and got rid of a bunch of debt. So it's interesting to see the trend has actually been better. Now, what state do you think has where's my notes here? Okay, so we have 705. I think it's on the next slide. So go 705 on the next slide. Yep, 705. That was according to Equifax. That's what they're saying is their middle credit score. So what state do you think is the highest credit score?
Alabama.
They have one of the lowest.
I know. Rhode Island.
No, it wasn't Rhode Island.
Okay,
That's what I thought. I thought it'd be Rhode Island. It's actually Minnesota, of all places, which I thought was pretty interesting, at 730. So the average credit score, according to Equifax, is 730 for Minnesota, followed by New Hampshire and Wisconsin at 727. So now what has the lowest?
Alabama.
Nope. It was close. Wonder why.
I don't know.
Mississippi at 675 and Louisiana at 680. So we're here in Utah. We have Utah, Nevada, Arizona, California, kind of the western part of the country here is where we do a lot of our lending. So what would you say Utah? What do you think the middle credit score is for Utah? It's gone up a lot.
Is it above average?
Yes.
Oh, really? 706.
Nope, 719.
What? No.
I know.
Wow.
I know. This is right off a website, off of Experian or Equifax. This is right off Equifax's
I need to have more faith in humanity.
And it's up. Same thing. I think I saw Utah at like 686. I think even one of the podcasts we did very early on, I think I mentioned that number because that's the number I've heard so many times. But I want to update the numbers and show what Equifax is actually showing as an average credit score for the state. Nevada. What do you think Nevada is? It's also gone up. All of them have. I think everything I saw went up. What do you think Nevada would be?
Above Utah.
No.
No?
No.
Man, I am wrong on everything. I should not be on Jeopardy.
You have little faith in people, my friend. So 691. So Nevada's at 691, Arizona 703, and then California also surprised me a little bit, to be honest, 712. But when I was looking at these numbers, it was like 5 years ago, maybe even 10 years ago, almost everybody's in the upper sixes. So it seems like everything's about 10 points higher from the last time I looked at these numbers. And it can be a little different with Experian, TransUnion, Vantix score versus FICO. So I'm sure you'll find some numbers online if you research this, but I pulled this right off of Equifax's website as I was preparing for the show to try to get the most updated numbers on what they're pulling as actual scores. And I will say Equifax is usually one of the higher scores, a little bit higher than the other two as well, but we're talking within a few points. But I think it's pretty interesting to see some of the scores and how almost all of them have trended up a little bit over the last few years. I think collection companies have been a little bit more scrutinized. Medical collections have been a little harder to put on there. So I think some of that factors into why scores have increased. But I've also seen record low defaults. Bankruptcies have been lower. So some of the things that really hurt scores have been lessened over the last few years. All right, let's go on to our last myth. We'll go on to our last couple of slides here. Renting is cheaper than buying. There's 3 points I want to make. Now, there's a time and place for renting. I don't want to say that I'm anti-renting, but the sooner you get into home ownership, the better you will be in the long run. Now, in St. George and some of the areas we service, like Clark County, Nevada, that kind of thing, there is a bigger separation at first. It is cheaper to find a rental at $1,500 than a house at $1,500. So there is going to be some long-term nature of the difference between renting and owning. But I want to bring up 3 biggest points of why you want to get into home ownership sooner than later when it comes to renting. The first one is appreciation. This is equity. This is net worth. Will never increase like it will without home ownership. It's just how that's built in. You're paying down a loan as you're making a payment. With renting, you're not paying down any loan. You're not gaining any equity. You're not gaining any appreciation at all when you're renting. Next one is rent increases. This is where you're going to see that mortgages are way more stable. The payment stays way more consistent than rent. And we've seen rent really increase over the last 4 to 5 years, and predictions that may even increase on the next wave. And oftentimes I'm talking to people that their leases are going to expire, and very few of them, unless it's a family situation or somebody that has a free and clear house or doesn't worry about really raising the rents at all, most people anticipate their rents going up when they go to renew. It's not a matter of if, it's usually a matter of how much. How much can they negotiate? Can they try to get the guy to stay at the same payment? So every year you have to kind of cross your fingers. Is my rent going to go up? Because the expenses to the landlord's gone up. The property taxes, insurance. This next wave, a lot of people have seen homeowners insurance. Some areas you can't even get it. Or if you get it, it's like double and triple. Or you have to use lender paid type insurances, which only protect the loan, don't even really protect the asset. Insurance is going to be a little bit of an issue here in the next couple years, I think, as it filters itself out, that cost, that expenditure is going to be passed on to the renters. The landlords aren't just, in most cases, can't just eat that if their payment's going up on their loan or the cost to maintain the property or whatever it might be has also gone up. So that's why there's just pressure to move rates up, where once the mortgage is in, it's a 30-year fixed rate. Now, sure, the property taxes might change, the insurance might change, but that's usually spread out over 12 months within your escrow account. And it's usually very incremental. It's a much smaller increase than you'll ever see in a rent increase. I very seldom have seen an escrow account jump more than $10, $20 kind of thing, depending on the price range of the home, obviously, where you obviously see rent can go up $100, $500. I mean, it can make a bigger jump, and that could be every year, where property taxes and insurance don't usually have that big of a jump year over year. And then lastly, tax benefits. There's not any kind of tax benefit on renting a home. Now, you might be able to run a business and there may be some write-offs there, but there's more built-in, easier access to the interest you're paying. So even the interest you're paying, you have a potential to write off on your taxes. So it gives you that additional incentive and benefit of buying a home. So let's go to a couple slides here as well to kind of prove the point of what I'm trying to make. This one right here shows that if you bought a $450,000 house, what that house will be worth in the next 5 years more than what you paid for it. Show me any rental where you have a potential of a $90,000 increase in value on a home worth $450,000. I mean, that's just incredible return on top of you've got to have a rent payment, a housing expenditure. You're going to have that expenditure anyway, but now this one actually gives you a return on that investment by not only paying down the balance, but also any appreciation. And this actually used a factor of like 2.3%, which is an average of 10 other indexes that are forecasting 2025, 2026. So it's even on the conservative side of how much more that home's going to be worth in 5 years. So yeah, the payment's going to be more, but look at what rent will do between the 5 years, most likely go up and will not have that return on investment. I saw a report that showed that homeowners have 20 times more net worth than renters. And this is one of the big reasons, is that appreciation. Now, a lot of people say, oh, there's a housing crisis, there's a housing crash, it's got to come, all that. They've been saying that since interest rates hit 8%, and home prices have still improved because there's still 20 million less homes than buyers right now. We still have a massive shortage of homes around the country. Because of that, we have to build the homes. There's not as many homes that are existing, like pre-existing homes that are going on the market. And the reason being is the home prices have gone up and the interest rates have gone up so much that people can't replace their current house. So they're staying in their existing home longer than usual because they've got a 3% interest rate or even a 4% interest rate. So they're looking at it and say, well, if I sell this house, I've got to go up $200,000 or $300,000 to be an upgrade to the current home I have, and I've got to go up 2 or 3 points on my interest rate. So many of them are just staying where they're at. They're doing home improvements. They're adding on to their existing homes. They're doing cash out refis. They're doing home equity lines of credit to make the home fit better instead of just upgrading. So we're not seeing any kind of wave of inventory other than having to build the homes. And building the home is going to be more expensive than one that's already existing. You got to deal with the labor costs, land costs, survey. There's so much that goes into a new development of just raw land that will always be more expensive. The home that's brand new at 1,500 square feet will always be more expensive than a home built 10 years ago that's 1,500 square feet. It's just the change in the cost of those types of things. So I think it's pretty interesting to see this graph, see the actual number of how much it will be. What if that number is cut in half? What if we say, okay, 2%, way too much? Even cut in half, that's $45,000 more, plus paying it down, plus tax benefits, all the other features than if you were renting a house. Now let's go on to another slide here that I think is really interesting. This slide, there we go, that works, all right. This is the increases in rent as a chart, unless it disappears. Oh, hey, we're trying out some new ways. We're actually doing it over the shoulder here, and then we also have like where it's up on the whole screen. So he's playing with it as we're doing it. I love it. I love it. Freddie Mac, the guy the producer. All those producers out there have nothing on my guy, Freddie Mac. Anyway, so here's the increase of rents over the last 60 years. Look at how often it stays the same or goes down over that entire time. I think the last time was 1995 through about 2000. That's the only time it's really even seen a adjustment down in 60 years. But look at that point since about 2005 to now. Look at those spikes. So that makes you think, okay, there may be another level off period coming, but this is the consensus that rents don't go down. They just don't go down. The price goes up. The value of the home goes up. People sell and buy these rental properties at higher prices, so they have to service the debt a little bit more. Taxes go, things go up. That's what it is. The hope is the income and everything else rises with it is the hope. But when you have these inflationary years, these bubbles, it just really adds to these negative rents. But look how much the same homes and everything over that time frame have gone up. But a mortgage during that time would not have gone up not even close to that amount of time. Plus, if rates do get better, there's always an opportunity to lower your mortgage payment, where you'll never really be able to lower your rent payment. It's very, very rare if it happens at all. And so I think these charts really point to the fact that buying a home is going to be cheaper than renting in the long run. Now, upfront, yes, it's going to be more expensive day one. It really will. It's very rare to find a $1,500 rent payment and a $1,500 house payment. It's very difficult to find that matchup. In certain areas, it's never been very close. But if you're able to get into a home, it works, it matches, you can always refinance if rates get better, and you will have a locked-in payment much more consistent than renting. And the last topic I want to talk about, so we got the appreciation, we've got rent increases and stability, then you're going to have tax benefits. We talked about that a little bit as we started this little segment. So when you have a mortgage payment, the interest you're paying, it's one of the loans that the federal government, to incentivize people to buy homes, you get what you paid in interest as a potential deduction that you can write off. I've seen many people, it's almost like having another kid. It's almost a similar deduction depending on the loan amount, the interest rate. There's some factors that go into that. But it's almost like having a whole nother dependent that you're able to write off. So I've seen people be able to adjust their W-2s, adjust their withholdings to not have as much collected through the year because now you know you have that deduction. Or again, you get a bigger refund at the end of the year. There's never been an incentive to have part of your rent payment going towards any kind of tax benefit. Now, you might have some tax benefits of being able to rent, use a home office or something like that, but you'd have the same thing if you own the home. It wouldn't make a difference if it was a rental or else. So if you're getting the tax benefit that isn't interest payments on your current rental somehow, you'd be able to carry that over in most cases to a home loan. So I'm not a CPA. You want to check with your situation. You want to throw that disclaimer out there. You want to check with your individual circumstance. If you already have a lot of other deductions, or if you already have so much interest deduction off of a bunch of properties, then maybe that won't be a factor. But at that point, it's investment properties. You're in a whole different category than somebody that is going from renting to owning in most cases. So I hope this can demystify some of the things we're talking about here. And I find that so many people are waiting for a magic interest rate. And there's a lot of wait and see. This election year, just things that are going around, the talk about interest rates lowering. There's so many people that are in this wait and see mode. And I found an interesting stat that right now maybe 2 people can afford that $400,000 home. If rates drop, now all of a sudden there's 10. If rates drop to a certain degree, maybe it now is 15 people that now can afford that home. So who's going to get it? The one that offers more, the one that can put more money down, the one that is able to close quicker. Something within those 15 people, the seller is going to take the most competitive offer, which usually means a higher price. We saw that during COVID. People weren't mispricing their homes. They were just getting way more than they were asking for because there was so many buyers and not enough homes. And people were trying to get out of certain areas and interest rates were so low that people really were jumping on the bandwagon. Then if you have federal government starting kicking in credits for buyers, where they get tax credits or down payment assistance, even more this free tax money, which is never free, whole nother topic. But what is that going to do to the demand? It's going to increase demand even further. So I really feel there's a magic little window here that if you can find a home that works, that fits within your budget, it may improve. If rates get better, great, but you can't get the better price. So if you buy now and rates get better, there's always an opportunity to refinance. But if you wait to buy, you might miss out on that house, first of all, or you're going to be competing with a lot more buyers, which means the price most likely is going to go up more than the better interest rate. If the house goes up $50,000 and you only saved 1% off the rate, the payment ends up being more. So it's better to look at it now. I really think there's a wave coming. I think the first quarter of 2025 is going to be pretty crazy. The summer of 2025, I think there's going to be a lot more activity of buyers because there is prediction of interest rates coming down. So I really want to talk to you about it. Go to my website at ryanbolton.com. We can start the pre-approval, get you ahead of this curve. That way, when you find a home that fits, let's get you the home. There's a saying, marry the home, date the rate. So if you can find a home that works, you really should jump on it as soon as you can. Love to earn your business. I lend in Utah, Nevada. Check out ryanbolton.com, and we'll see you on the next show.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.